Equity Mate!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in roughly 20 minutes or less. We break down the world of investing from beginning to dividends so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
Very good, Bryce. We're sitting in the same room, which is a rare occasion.
And for the first time, I'm actually down in Melbourne.
Yeah, it's about time we...
You've heaped the pressure on.
Yeah, shared the load.
Yes.
Yeah.
So I've forked out for flights, and here we are.
Yeah, there you go. Good to see.
Yes, in your apartment. Went and saw the Bombers
House
live
even,
last night.
you know?
Sorry, house. Yes, sorry, house in
I
Richmond.
wouldn't call it an apartment.
We've just given away. There is a third person here. So I guess we can crack straight into it, Ren. I was going to talk about the Bombers' win last night, but
Well,
we're not
maybe this mystery guest can also join that conversation.
Sure. So for the first time ever, we are going to be doing a Mates of Equity Mates interview.
Yeah.
We have previously been interviewing experts in the field of investing.
Who are our mates?
Who are our mates,
But
yes.
this is the first mate that predates Equity Mates.
Yes, and the
I
whole...
mean, it depends how you define expert, isn't it?
Well, we originally set up Equity Mates to actually try and track the journey of our mates as we learnt to invest.
Yep.
Unfortunately, no other mates got on board. We have managed to find one, though, that has shown a small interest in investing. So we thought we'd sit down with him today and just chat through all things investing from a beginner perspective.
We thought we would exploit that interest for our content.
Yes. So
The
without...
keyword being small groups.
So without further ado, Ren, I'll let you introduce our special guest because you do live with him.
I do. So, Kip, welcome to the show.
Hello, equity mates. Is that what we call I'm
Yes.
not part of it. Is that what you call your guests? And that probably shows how few episodes I've listened to, because I'm not sure what you call your listeners.
So one of the hardest things for us, Ren, has been able to crack our mates listening to the show.
Mm-hmm.
I think just because they get wigged out about the sound of our voice and they probably somewhat don't trust what we're
Yeah,
saying.
you wouldn't think of us as experts.
Yeah.
Are there any?
Any what?
Any mates?
Any
that
mates
listen?
who listen to it?
Yes.
I've listened to 2 episodes.
So less than 1%?
Yeah.
Yeah.
But 2 good episodes.
I remember them being entertaining. I couldn't tell you what they were about. I think one was maybe like, what is a share?
Yep,
What's
good
the
start.
Yeah. Could have said they were about investing. That's generally a safe bet.
Yeah, that would have been
Yeah.
safe.
Well, Kit, do you want to just give a bit of a quick intro into a bit about your background and how you have become Kit? And then we'll get stuck into...
You don't have to give us too much detail on how you became.
I guess it goes back to 1992 when my dad, Gavin Frawley, well, no, that's getting a bit too personal. So I guess I met you guys up in Canberra when we started university together. Sorry, listeners, I've got a bit of a cold. I've been carrying a bit of man flu all week, but I said to Bryce when he arrived today, I'm all better, so I'm not contagious.
Good to know.
Yeah, I guess we met at university. We all lived together at different stages. I think we overlapped. Were we all in the same house? Yeah, we
were, yeah.
6
At the
months.
same time. I was studying law at the time. I'm now a lawyer, and I've been doing that for a few years. But I've been living in Melbourne since midway through last year when Renners and I started living together. Before that, I was in Wangaratta, which is where I grew up.
Tigers supporter,
Tigers supporter.
through and through.
Long suffering.
Have seen him cry
Was
over Tigers.
long suffering.
Thought dinner should go.
Thought dinner should
No,
go,
I don't think
yeah.
so. I don't remember that. I do remember I'm one of 5 kids, 4 boys, 1 girl, and one of the happiest moments in my life, which this could be uplifting or could be quite sad, was 2017, being at the footy, watching the Tigers demolish the Crows with my 3 brothers, dad, and one of my brother's mates. It was a special moment. Yeah.
I can imagine it would be quite exciting.
And Tigers have been going well since then, so we're not getting
Tough
too
year
down.
this year. But
not
anyway,
really sit down.
we're not here to chat football.
And when you're playing your two side in a ones
Here
class,
we go. We're not here to chat football. So let's move on to the investing side. I think that's what everyone listens to the podcast for. So I think from my point of view, Kip, I'd like to start by just, I guess, making note that through uni, we did live together. You've always been quite careful with your money. And don't
that makes me
necessarily...
sound like a tight ass.
No, you're not a tight ass. You're just, I guess, selecting what you spend it on and no unnecessary spending, which I think for a beginner is important when it comes to putting money away for investing. Since starting full-time work, have you at all made any investments outside of, obviously, cash in the bank?
So I invested in a car, if you can call that an investment.
I would say no, but
As soon as you drive away, it starts losing value. So,
but if you classify that as investment, fair.
I mean, I don't, but that's where some of my money went.
Yeah.
Not that we're here to talk about my car. I don't really like it that much, and I'm going to get a new car because I'm looking at a four-wheel drive. But I did put a significant amount of money into a car. I'll recoup some of that, but you're right, it's depreciating in value as we speak.
Any assets?
Outside of that, I have bought some shares.
Mm-hmm.
I guess my understanding of shares is probably limited to my dad coming home from work when we were kids, him checking the finance section of the news, and I remember him having Coles Myer, CommBank, NAB, just blue chip shares. So that's what I remember about shares growing up, and it really didn't, form part of any sort of meaningful part of my life. I certainly wasn't interested in it through school or through uni, and it probably wasn't until you guys started doing this that that my interest was sort of peaked.
So have you bought any shares?
I have, so through Stake, and this sounds like it's going to be a little free publicity, but through Stake, Renner's encouraged me to get on there, so it was relatively easy, I think, for someone who doesn't know where to buy shares or how to do it or where to go. Renner sort of walked me through it, and it was literally like shopping on eBay and just clicking, well, I want some of that and I want some of that. So the plan being that I'd eventually, I guess next year I'm moving into a stage where I want to have at least sort of about 10 grand in shares. It's like a mini goal.
Good goal, yeah.
At the moment I've got 2 grand in, and I'll sort of continue to chuck that in every few months. Yeah.
and so the big question I think is, what did you buy first?
Off your suggestion,
We don't give tips.
We don't give share advice.
it wasn't so much advice, more a suggestion, picking something that I was interested in. We were talking before about my Google phone and how superior it is to an Apple phone. I like
Debatable.
Google. I like their products. I like what they're about as a company, and I have some interest in them, and I think they'll do well moving into the future. So that was a reason for one purchase. And now I can't even remember what the other share I bought was. It was an EFT.
Yeah.
It was a Vanguard S&P 500.
Nice.
You
Yeah.
can remember that.
There you go.
So 2 stocks that are American, exposure to the American market.
Yeah.
And very recently in our WhatsApp group, you showed interest in wanting to buy more and wanting to know how you can do that outside of Stake.
Yeah.
Because obviously Stake, as you mentioned, is American only. So have you had any further thought on what the next step is going to be? How are you going to get to that 10 Gs?
That's why I'm here. The money side of things is enough, because at the moment, again, it sounds like I'm cashed up and I'm just sitting on a big pile. But I think I have been saving, which I think is something I've pulled out of, what are the weekly starters? Equity
Thought
starters.
Yeah.
Yeah. Loving these plugs that you're giving us. So keep it up.
Well, you made me sign up for it now. It comes through every Monday, and
It's good, isn't it?
I flick through it.
That's all I ask.
It's mildly interesting. No, it's great. You should check it out if you haven't checked it out. And I think one of the articles or one of your little blurbs was saving to invest instead of saving for saving.
Yeah.
Or maybe I heard
Don't
that somewhere
save to
else.
save, save to invest.
Which is what I'm doing at the moment. I am saving For saving, I'm getting 3.5% with ING. Again, not a plug, just the bank I use.
Okay, that's all right.
It's better than most banks these days.
Yeah, but I am saving for a purpose, which I'm not going to fully disclose here. But
Yeah.
It's all right. We don't need your life story, just your investing one.
But I do have enough to put aside to invest as well. So the idea being that, I'm going to work towards that, towards the end of next year, have 10 grand in a diversified enough portfolio. And so part of that is going to be having some in the Australian market, maybe some in the Asian markets, and maybe some in the European market. But you did ask about Uber and whether I'd thought about anything else. So that didn't really answer your question.
We can talk about Uber in a sec.
Yeah, let's before we move on from the beginnings, this part of getting you on and trying to get some of our other equity mates on is to talk about your experience starting and some of the questions that you had, because if you've had the experience, chances are a lot of listeners have had this experience and they just don't have the platform to ask.
We've had the experience.
Well, I mean, our listeners are sick to death of us talking about our experiences though. So before you signed up with Stake, if you put yourself back in those shoes, what were some of the big things that were stopping you, or what were some of the big questions that you had before you started?
I'm a face-to-face sort of people person, and having a bit of sense of security and signing along a dotted line, or having a bit of paper. So I think part of it for me was, you mentioned a couple of platforms. I didn't feel entirely confident about, handing over, as a starting point, a couple of grand, which, it's not going to get you a house, but you don't want to lose that. Not being confident enough, I think, in the different institutions there are and where your money's going, especially if it's going overseas. In a sense, you lose the jurisdiction. So that was one aspect to it. The other aspect was just not knowing where those platforms are. I knew you could do it in a bank, but my bank didn't do it, so I did have to sign up with like CommBank or, someone else.
What about your fear of loss? Like you mentioned it, but I understood that to be fear of loss by not trusting the institution itself.
Yeah.
Because one of the things that beginners always talk about, I'm thinking one about my housemate Ryan, is, I just don't want to lose the money. And we've all known, we've spoken about it for 2 years, that the likelihood of you losing money is real, but you only need 3 out of 10 to come off, and it pushes it in the opposite direction. So I'm wondering how you feel about that.
I don't think that's ever really formed. Actually, no, it would have once upon a time. I think if you asked me that 5 or 6 years ago, definitely would have been informing my thinking. I was like, no, too risky shares, not for me. Whether it's hearing a bit from you guys or just, a few more years under the belt and a bit more life experience, I think at least listening to the experts, you hear that really the upwards trend of the market. If you're in it for the long game, which I guess what my investing would be, I'm not chucking in a couple of grand hoping to make 500 back in 6 months. That wasn't really a concern. Yeah.
That's good. I think that's one of the hardest things to overcome, really.
Yeah. To stop thinking of it like gambling and start thinking about like long-term investing.
Yeah.
So you're worried about, giving your money to some company that you didn't really know about. There are a few barriers to entry because your bank doesn't have an investing platform. What was it that helped you overcome that?
Renters.
Nice. Equity mates.
So the lesson for everyone is just to live with someone who's interested in investing.
Maybe it makes it easy.
But we know that that's true, right? It's that whole social proof thing, right? If someone else has done it and it turns out you get confidence just by knowing that others have done it before you and whatnot.
So what you're saying is, if you're listening to this and you have no friends that have done it, you
need
could
to
be that
find
social proof.
Exactly. Yeah. Or find someone who is doing it and just stand next to them and you're like, okay.
Or just use us as your social proof.
Yeah.
Use Kip as your social proof. Yeah.
So now that you have invested, how do you treat those investments? Do you look at them daily? Are you spending more time looking at the markets in general now that you're invested in a broad index?
No.
Has it triggered your interest in it any further other than knowing that you probably want to put another HEs in at some point?
Yeah, I think the latter. So No, I don't really check on them. I've probably opened up the Stake app half a dozen times. Some days it's in the green, some days it's in the red. But that was never really going to be a concern because, again, the money I'm putting in, I've flagged and recognised that I don't need that money for the next 12, 24, 36 months. To the extent that it's generated any other interest, I mean, when Renners brings home the AFR, I sort of flick through it and I think I should read that, but then I don't. I think an area of interest of mine generally is just trying to get to understand and know a bit more about the energy sector and renewables. So I think in that sense, that's an area that I'd like to maybe invest in. And I can't remember if I was speaking to you, Renners, or my brother about getting into something like AGL or a specific company like Origin Energy. But I think more and more I'm thinking I would like to get just into EFTs that focus on certain areas. So whether it's like a Central European EFT, the Germans do things, ETF. There you go. Why didn't you correct me the first time I said that?
I didn't pick it up. I didn't pick it up.
I didn't want to be that guy.
You should have. EFT is the bank transfer, isn't it?
Yes,
Yeah,
electronic funds transfer.
Yeah.
So you're two in the banking world, mate. You need to get in more.
See,
in the
when
investing
I
world.
said what shares I had at the start, I think I said I've got a Vanguard, S&P, EFT, and you're both like, yeah, nice.
I didn't pick up EFT.
Yeah.
Anyway.
Renners.
Renners. It's like not calling out someone having food in their tea.
We were going to edit it out in post-production.
Anyway, yeah.
So yeah, that's sort of the general plan. Rather than trying to pick specific companies, letting the experts do it, and just sort of what's it called? Set
and forget.
Set and forget.
Yeah.
Because I'm not interested enough. I want the money to do its thing in the background, and I can go and do other things that I like doing.
What's one of our key messages, isn't it, Ren, is to forget stock picking?
Yeah. I think you've got a very good attitude and temperament for it. Because like people early days generally are nervously checking all the time and, you know, riding those highs and lows.
Well, they want the quick win. That's half the issue
Yeah.
as well.
Yeah.
People expect to put money in shares and it's just going to, you know, as you said, it's going to be that you put in 2 and walk out with a house. I mean, it's just, it's not going to happen.
It
like
could,
that.
but it'll be 40 years of waiting.
Yeah. You might get lucky in the first investment you put in, it does double its money, but like you can't go in with that expectation, I don't think.
So you're now in the market, and you did. We flagged this earlier, but you messaged Bryce and I a couple of days ago asking about Uber. So tell us your thinking on Uber, and is it something that you have bought?
I've looked at it. I think the share price is like $38 or $40 at the moment. So I thought from that sense, it could be fun to just have one, a bit like Google that I've got. Have one and just sort of see how it tracks.
Yep.
As a bit of a pet project.
Whatever gets you interested.
But what did I see? I saw Uber Air on the news the other night in Melbourne.
Which is?
Good question, Bryce. Uber
Well, I
Air.
had to Google it. I didn't know.
Oh, really?
No.
Okay. There's 3 trial cities. Everyone listening would know what Uber is and what Uber does. Or if you didn't, you'd probably been living under a rock. Uber Air, I guess, is transforming the transportation grid and turning it 3-dimensional. I think the idea being we live in a 3-dimensional world. We've got skyscrapers, you know, we've got air transport. But at the moment, our transportation grid is 2-dimensional. You've got trains going along, you've got bikes, you've got cars. But we've got all this unused space and potential. And at least from what I can tell, the idea being these pilotless Uber drones, light aircraft, whatever they've called them. Imagine like a Avengers or X-Men type helicopter that launches vertically but then tilts its propellers and moves forward like a light plane. So they take off, whatever the aeronautical terms are, take off like a helicopter but then fly like a plane.
This is what Uber's bringing.
That's what it was bringing. And there's 3 test cities. I think one was San Fran, one's Melbourne.
Do they have a pilot or is it automatic?
Just go listening.
I know, I'm listening. I heard you.
Oh, sorry.
Yeah.
Maybe they're starting off with pilots, but what I heard was pilotless.
Wow.
Pilotless drones on it. Like,
And
So
so,
they-
is it like just programmed in? They know where to go, or
Yeah,
Well, I haven't done that much research.
this is crazy.
2023.
They must have designated pick-up and drop-off zones.
They will. So
Yeah.
it'll be like the top of skyscrapers. So I think it'll be for businessmen and women travelling between.
Yeah, because I mean,
So
I'm
it's
not
like-
about to walk to the top of the 50th floor to
There'll
catch
be
an
an
Uber.
so it'll be like carrier pigeons. So like they know where to go back, and then they go.
I guess if you want to think about it in carrier pigeon terms, then maybe. But
There's not-
Are the Saudis doing this though? Don't they have flying taxis already in
Maybe
Dubai?
Maybe the Uber taxis.
you know what I picture? I picture The Fifth Element.
What's that?
You know the movie with Bruce Willis?
No.
I think we were watching it recently.
Check it out. I think it's not just limited to that. So it's not just helipad to helipad transportation. They're going to incorporate it into their entire network. So maybe there's an active transportation component. So you ride a bike that you'll pick up. That'll take you to a car, which will take you to a building. Building up the top, elevator. Drone takes you somewhere else, and then there'll be a car waiting for you at the end.
So okay,
So
keeping
it's all
everyone in the
linked.
loop.
Yeah.
Good way
Does-
to avoid traffic.
Does that reduce congestion below? I think you'd have to have a fair few drones
Isn't that
flying
nice?
around.
You get sky congestion.
But I like the fact that it's a company that's already on the ground, pardon the pun, but bringing something else in new. Like, who knows what's going to happen in the future, where it's going to take us, but I like that they're at least pushing the boundaries now with their ideas. And 2023 is
It's not that far
close.
away.
Yeah.
Yeah.
And Melbourne's one of the host trial cities, whatever you call it.
Wow. Okay. So it was for that reason that you have considered investing in Uber.
Yeah. And now that I think about it, maybe I would.
Nice.
Nice.
Why not?
Talk yourself into it.
I mean, do you use Uber Eats?
Not so much. I cook every now and then, maybe once a fortnight.
Yeah. Okay.
Yeah, once every 3 weeks. I mean,
So,
don't hold me to that figure, but
Uber just IPO'd, what, 2 months ago maybe?
Yeah, about that. Yeah.
And have slowly been coming good from a share price perspective. You know, they bombed 20% in the first day or something, didn't they?
Yeah.
So keep us posted on that, Kip. So obviously you'll buy that, I assume, through Stake.
Yeah,
'cause
through
it's
Stake.
It's another American company. Anything in Australia that you have considered at all?
I think I'm gonna put in. This would probably be the incentive for me to do it this week because I've just been. You guys wouldn't have this experience, but I think once you're in, it's just so much easier to go again. It's like a gateway drug, I guess, or something like that. Or like any new skill. Like once you've done it,
Yeah.
it's so much easier. So this will actually prompt me to do it. But at the AFIC, I'm not going to get the acronym, but is it the Australian?
You're talking about the listed
Yeah.
AFI, isn't it?
AFI.
Yeah, Australian Foundation Investment Company. Yeah.
Yeah.
I think one of our mates, Flynn's, invested in that.
One of the oldest listed
Yeah,
investment companies.
super old. Yeah.
Yeah.
So how'd you come across that one?
The Barefoot.
Oh, yeah.
Don't. He who shall not be mentioned.
The only reason we say that is because we've tried to get him on the podcast and he's too big for...
Not only that, because his book. Anyway,
I'd like to say
going
he's too big for his boots, but he doesn't wear boots. He's too big for his socks.
Okay, so nice. So obviously that's a recommendation of his in the book, is it? I haven't read it, and I won't be.
It will not be a book club.
It's funny you say that, Bruce, because I was in your place in Sydney recently and I saw Barefoot for families on your
Hey,
bookshelf.
I'm planning a family, all right?
So either you've not read
I'm not
that.
for listeners who are out there. And it was market research only. Yeah,
sure.
I haven't. Yeah. Anyway, let's
He
not.
read it, but he didn't take a word with it.
Let's not give
Also,
it.
if I'm not being, if it's not too critical, I actually speed read.
Yeah, the whole book.
Speed read. Is that what how you would say that?
Sped read.
Sped read. I
Anyway.
speed read it at your house, and it was pretty much a copy of the first book.
It's a
which is-
colouring in book.
No, it's not.
It's pretty much.
Bryce's market research isn't quite there yet.
Anyway, so
But it remains-
AFI. Let's talk through AFI. It's a good place to start, I think.
Yeah.
Pretty
So I guess-
well diverse, solid, consistent. I think pays a pretty good dividend. Great place to park some money as first off. Yeah.
So I guess my strategy was I had about, I keep talking about this 10. I had about 10 grand that I thought I could put in and not need, sort of set and forget. And I didn't want to put it all into one time. And a friend of, actually it was my girlfriend's dad recommended or said to me, there's going to be no perfect time to get in. One approach is to put 30% in now, 30% in 6 months, 30% in another 6 months.
Love that.
So I think that's sort of what I'm aiming for. It's been a few months since I put that in. I might put in another 2 in AFI and in another 3 months, make a pick. So that's sort of my approach and what it's going to be.
Yeah.
Yeah.
So the great thing that we're hearing is that all of these things that we talk about, you're sort of naturally doing. So like that's called dollar cost averaging. You've got a very long-term focus. So it seems like you've got a lot of the building blocks there, Kiva. There's a lot of potential there.
I love that approach. I think a lot of beginners get scared about trying to time the market. And that's one of the best ways that you can avoid, worrying about that. It sort of falls under that rules-based investing approach, which is you just say, I've got 8 grand and I'm going to say every 3 months, regardless of what's going on, I'm just going to buy X. X takes away the fear of, is this the right time? Over that period, you'll just buy in. So I think that's a really solid approach.
What do you guys know about Uber that led you to instantly dismiss me with that WhatsApp thread?
So for some context, Kip did message both Ren and I saying, can't read it out, but yeah, what are our thoughts on Uber? And I think Ren was quick on the text to reply, nah, don't do Uber.
Yeah.
And I would also follow suit with that. But then you did follow by saying you should back your conviction, because I think that's also very important, because Kip had a few reasons as to why he thought Uber might be a good investment, Air being one of them. And so, by all means, don't listen to what Ren is saying. But what are your thoughts, Ren? What's your answer to Kip?
So, no one knows what the future will hold. But if Uber continues to just be a subsidised taxi service, there's probably some concerns about how financially viable it is. So right now they lose about $1 billion a quarter. And the best description I've ever heard of Uber as a taxi business is it's the world's largest wealth transfer scheme. It takes money from rich investors and it pays out subsidised transport to everyday people. Like every fare that Uber run, they lose money at the moment. And
the cost of that is going up. I think they lost 40 cents in every dollar for their first trip, and now that's 67 or something. So.
And the logic of that potentially is solid. That you undermine taxis, and they well and truly undermine taxis, and then everyone uses Uber, and then they dominate the market. They can raise prices in the future. They get enough volume. They get enough network efficiency. Their cost of doing business per trip goes down. There are reasons why that could work, but for me, there's increasing competition. We see Ola and a whole bunch of other ones. In America, Lyft is also quite big. So the question is, potentially Uber has just paved the way, smashed the taxi industry globally, but what's going to happen is they're not going to dominate the market. Instead, the market will fragment into a bunch of different ride-sharing companies.
They may with Uber Air, though.
They may.
And that's
why I say I don't know what the future will hold. If Uber Air becomes ubiquitous and everyone's flying around in the Uber-owned air taxis to work, then they're worth close to $100 billion now. They might be a first $1 trillion company.
Yeah.
It's starting to sound like a lousy investment now that you say that. It's not like Ansett Australia, that they weren't the only ones flying domestic.
The hard thing with this is that it's so disruptive that we don't really have much to benchmark it against in terms of what... We're in an era now where so much private investment is going into tech companies that are losing so much money. Like, these companies are coming onto the share market with terrible balance sheets, yet it's all about market capital, capturing as much market share as possible for that unknown period of time where they could then utilise the billions of people using it. So it's very much an unknown.
There is logic to that. The logic of that for tech companies is the incremental cost of each additional user is next to zero. So like Netflix is willing to lose heaps of money because it doesn't cost anything for you to sign up if I've already signed up, like the content is what is their big cost. So if they can spread that out across more users, their path to
It's cheaper
profitability
and
is
cheaper.
easier.
Yeah.
The question is that the case with Uber? Is Uber a tech company where they've got a high fixed cost and low variable cost? Or is Uber a more traditional transport company where each incremental ride that they add to their fleet, each additional ride they sell, there's a whole lot of extra costs that they incur. And
I guess I obviously haven't done, aside from watching the 7 o'clock news at ABC Melbourne, haven't done my homework, so to speak. It's quickly becoming apparent. However,
that wasn't the point of this.
No,
No,
it wasn't.
and no
However-
one really goes to the level of, like, you don't, anyway.
Correct.
It's- Yeah.
However,
First investment.
we don't know. Slater and Gordon.
Yeah, you cannot do worse than what I've done.
We don't know, and clearly I don't know because I haven't read enough about Uber, but maybe they're up there with Google producing some really great AI, which actually they mentioned on the ad or in their little 5-minute thing. AI and the development of driverless cars. So whether that then becomes their model and they're one of the leaders in that space and Uber Air really takes off.
That was a good one, kid.
We'll see.
Yeah, so 100% right. Like drivers are their biggest cost, so if they can do autonomous cars, it changes the game. When I was in the US in 2016, I saw the Uber autonomous car driving around. So they're in that race.
Well, if they keep getting class actions brought against them,
Yeah. But I feel for them, it's almost just cost of doing business. They'll wear it.
So, Kit, you've actually demonstrated that you've got a pretty solid base, as Rennes keeps saying, that, great attitude, pretty decent idea of what you want to achieve in terms of 10 grand into the market, pretty good approach to segmenting that across a period of time, reasonable idea of what you want to invest in, AFI or more of Uber or whatever it may be, maybe both.
maybe less of Uber now.
I guess.
Maybe some ETFs as well. And
Or EFTs.
EFTs, yeah. Still very early. Still very early days. What's, I guess, the next thing that you really want to understand to take the next step? Be it understanding brokers or, I don't know, what's something that...
Great question, Bryce. And I'm glad you asked. Super. In the Barefoot. He talks. There's all these steps, and if you haven't read Barefoot, I'd recommend reading it. Not.
This is not fun.
Bryce is ropeable right now.
Well, you guys can write a book if you want.
We are.
Well, I'll happily plug it and read
So are
it
you.
on my own podcast. The people you meet. Anyway, we can talk about that later. But super. Obviously, a lot of your listeners will know if they've got a job or a part-time job or just from living in Australia. Your superannuation is it taxed at 15%? The tax rate in your superannuation fund. Whoever you're with. I'm with Australian Super. I had to change my insurance recently because that's one of the things.
Yeah.
Barefoot, I think, recommends a bit of paying premiums. I don't need income protection.
If you listen to our superannuation episode, he would have known.
All right. Well, two things. I'm not looking for a house anytime soon. But I know the first time Super Saver is in, so that's maybe in 5 years' time I will want a home. So I guess I'm deciding between whether I start looking to invest through my super fund at that better tax rate at 15% or chucking my money in for a house. So I want to know, I think you asked me a question.
Yeah.
I want to know what you guys know about, the super light, I think they call it like super light self-managed funds. So you invest within your own fund. So not your own super, whatever you call it, self-managed fund.
Yeah.
You're with Host Plus or Australian Super or
You have more control.
not one of those bloody banks or something like that. Industry, one of those.
Yeah, industry fund.
Unfortunately, I'm still not with one of those.
Who are you with?
I'm
Sort
with
it out,
Contact.
man.
Oh,
Sort it out.
I'm on the elevator up here. It's not too late yet.
Anyway, that's not the question you asked. So
It's not too late. What are you doing with Contact?
I know.
it's just
He's lazy. We know he's lazy.
It
He's
was
just
just easy. Yeah.
so lazy. Anyway.
And then I was going to change, but then I looked at their fees, and their fees aren't that high. So then that was sort of a moment.
Yeah,
where I
but
was
they'll
like,
charge you when you're dead.
Yeah, but I don't need it when I'm dead. You can't take it with you.
Maybe by then you could.
Maybe.
We don't know.
Anyway, Bryce, do you want to? Do you want to?
later.
No, tell us now.
Well, I was listening to
No, stop plugging on the podcast.
Stop playing podcast.
Hamish Blake and Will Anderson were talking about, and I hadn't heard this, maybe your listeners have, but apparently they're talking about perhaps in the future drawing your soul or consciousness out and making that live through AI.
Is that like the singularity?
Wow.
Is that?
I don't know.
Now that's an investment.
Yeah.
Wow.
Would you want to live forever?
Yes. I would.
No.
We could unpack this, but I think the original question was on super light.
Yeah. Do you guys do anything with your super or?
So I am with Host Plus.
Great.
Really good. Really good.
Barefoot's favourite.
Barefoot's favourite. You didn't need to add that in.
You will not be coming back on this show.
Okay, so yeah, with Host Plus, and I didn't realise until we did our episode on Super a month or so ago that you could do that. I think invest in the ASX 300 with the top 300 companies on the ASX, and really take a lot more control over your superannuation.
You would have to know what you were doing though.
100%.
Yeah.
100%. Yeah, you would really want to.
You probably want to get some advice.
You would want to, get some advice or absolutely be very confident in your strategy.
Can you split it out? Can you do like 50% managed by Host Plus, 50% directed by you?
My understanding, and I could be wrong, and happy for anyone to correct me on this, but it is from a point in time. So up until, say if I choose to do it now, anything previous to that I think is set.
Yep.
But anything from X, you can then do what I want.
Okay.
I'm pretty sure. You needed a minimum of $10,000 balance.
Can
to
you
do
swap
that.
back and forth as well?
From what I understand, yeah.
Okay.
So you can do it in multiple ways. You can do it so that it will give you a whole list of assets, classes, cash, bonds, shares, international, etc., property. And you can say, I want 100% in this or 50 in that, 20, 25, whatever. And then it will do the investing on your behalf. Or you can go another step further. And with a minimum of $10,000 balance, you can invest directly into ASX 300 and choose specific stocks. I'm not doing that yet. I think broadly speaking, what they're doing is generally investing in the top 300 anyway, and giving exposure also to bonds and property and a bit of cash and whatnot. So the thing that I do is tinker with the percentage of what's in what, because there's, to me, no point now being in cash.
Yeah.
So I try and remove as much of it from cash exposure as I can.
Did you go over this, and this is getting a bit sidetracked, but it's on point. Did you go over this in your super episode, which I recommend to everyone listening? Go back and listen to it if you haven't. Did you go over the different streams of investing within your super fund? Because when I spoke to my fund, there's obviously different ratings. So you can be an aggressive conservative, or ultra balanced, or you went over that?
I think from our point of view, I don't think we touched on it in too much detail, but in my point of view, there's no point being anything other than aggressive.
At this age.
I think what we did say is that there's a general rule of thumb, which is just that, a general rule of thumb, and people say the percentage of defensive investments you should have, so bonds, cash, stuff like that, should roughly correlate with your age. So in your super, if you're 20, you have about 20% in defensive and 80% in aggressive, so mainly in shares. But then if by the time you're 80, you have about 80% in those defensive holdings and about 20% in the more aggressive stuff. So as a general rule of thumb, it's a pretty easy way to sort of think about it. As you get older, as you get closer to retirement, you get more defensive.
Super's an interesting one. I wouldn't, the way you view it, For us, we're not going to be able to touch it and I'm sure by the time it actually comes to us touching it, the government will have changed rules. Like we're going to probably live longer.
Might be dead.
Yeah, well, exactly. The stress on the economy to support baby boomers and that sort of stuff is only going to increase. So I'm sure regulation is going to change around super. And so we might not be touching it for another 60 years, perhaps. So what are your thoughts, Akip, on putting extra into super than you are already? And B, you're talking about like an aggressive approach. Do you have thoughts on aggressive or balanced or whatever it may be?
So I moved it to aggressive. I did get some financial advice. Maybe I think when I first started full-time work, and so I just contacted my fund, and it was really easy. Just moved it from balanced, I think it was, to aggressive. Who knows what the dollar figure result will be in 50 years' time, but I'm sure it'll be. Well, I hope it's positive. And it's the same thing. It's the same idea, right? Because I'm not thinking about my super. It gets taken out of my pay each week or every fortnight. It goes in. Don't have to worry about it. And so to answer your question, I moved it to aggressive for that reason. But I think, well, I'm not sure when I'll do it, but I will increase my contributions because I've had a look at the stats and I've heard some commentary from no one in particular around increasing your super to 15%. And the effect that compound interest has over time. And I was actually chatting to my brother over the weekend about it. We were back home for the Queen's Birthday long weekend in Wangaratta, and we were just walking along the river, clearly having a fascinating time talking about shares and finances. But we were talking about that whole idea of set and forget. So whether it's now or in 5 years' time, increasing that from 9.5% to 15%, I don't think I would really notice it once it was taken out. I think I could very quickly get used to that money missing on a fortnightly basis. Whatever it is, less coffee, I don't know what else I buy, but you could very easily get used to it.
Would you then consider moving it back down if you were to start saving for a house, for example, or is this something that you would move to 15 and then just... Because my whole point with this, and I've discussed with Ren, is it's that opportunity cost around... obviously, you're not going to be able to touch that money for a long period of time, so you could theoretically say, well, that X amount of dollars that would otherwise be going in super, you might treat as an investment in another form that you could access in, say, 20 years when it comes to, I don't know, moving to part-time work or whatever it may be. And I know Rennes has thoughts on this as well, but...
what are your thoughts?
So I think Bryce is right, but I also think the tax benefit you get from super gives you a real head start. If you're taxed at half the rate you're taxed at if you're going to just invest it normally, like you're going to get paid to invest it, the rate of return you need on your super is less to break even, if that makes sense. So I think taking advantage of the first home buyers super saver scheme is a real tick if you're planning on buying a house at some point, because it's money, one, that's tax advantaged, and two, you can access before you retire. Then I think after that, it just really depends on how much you spend, how much you save. Because Bryce is right, there's an opportunity cost. Like, you don't want to have $1 million locked away and not being able to touch it for years. But also, you're right, it's an easy way to save. So,
I mean, even if you did it to 12 or 10.
One of my financial, Jacob, he said 12.
The other thing is, though, like, you can change it. Like, if you have a kid and you get married and your expenses increase, you can go from 15 to 12 or from 12 to 10.
It's a comment you made when we did the episode, and I've been thinking about it. It's like now when we have the opportunity and we don't have any of those extra costs, it's
you can
like...
easily get used to it.
Yeah, smash it out now, and then if you do have a kid...
And
God forbid.
There are also, like we talk about compounding a lot, but doing 15% now and then doing 9% for the rest of your life will get you so much further ahead than if you're trying to catch up later in life and you're trying to do 15 when you're, like my folks are in that situation where they're trying to maximise their super
smash it out,
But like you're fighting a losing hand. Like you got to do it now.
Yeah.
So, not to dictate the direction of the podcast.
No, by all means.
This is your show, mate.
In terms of it is my show.
No plugs.
The people you meet. Watch this space. In terms of, sorry, I just knocked the table. In terms of my direction and wanting to put money into ETFs and getting a range of sectors or industries, whatever you guys call it on the podcast, and also a diversity of markets. So Europe, I don't know, Asia, Southeast Asia, whatever it is, America, Australia. Would you have... Where do I go to do that? I guess, where do I look to with my approach? So I'm going to be doing maybe a couple of grand every few months for the next 18 months. Is there a platform that's better than another to do that?
It's a good question.
Great question.
I can speak from my personal experience. You might have a different answer. Personally, for me, IG.com is it's not as intuitive as Stake or some of the banks. Like, it's a bit harder to use. But in terms of access to international markets, for me, it's probably up there with the best.
Didn't Bryce say you have to...
Yeah, so the caveat on that is that you need to trade at least once a month.
Yeah, otherwise you get stung a $50
avoid a $50 fee.
Yeah. So, yeah, look, if you're doing, a couple of grand a quarter, that might not be the right platform for you. For me, it's easy. It's all in one spot, which I like, and it's relatively cheap. But I think even if you were just on Stake, you could still get access to a whole bunch of different ETFs. So there'd be an ETF on Asian markets, on South American markets.
Yeah.
Does that mean they're American companies investing in...
So think about Vanguard. So Vanguard you would invest in like the Vanguard ETF, and then they would go and buy the 100 biggest Asian companies, and it would be like a Vanguard Asian 100 ETF.
Yeah.
Or like...
Is there a risk in that in investing in... Because Vanguard's like its own company, right?
Yeah.
Is there a risk in...
But even if you did that in Australia, it's exactly the same thing. You'd be investing in an Australian company that then goes out and buys the top 500 companies in Southeast Asia. So it's much of a muchness, really. They just are marketing themselves against each other.
Yeah,
exactly, yeah.
Now, the only thing, and this is probably something that you don't need to worry about at this point, but if you're only investing in, say, Stake, and all the ETFs you're investing in are US dollar denominated, then you might be diversifying across different industries and across different areas of the world. But if everything is denominated in the US dollar and the US dollar takes a dive, then you're 100% exposed to that risk. So there are ETFs that are called currency hedged ETFs, and so they take that currency risk out. So that's something that you can look at, and given you live with me, that's something we can talk about. But if the listeners out there are interested in it...
We'll take that one offline.
But every ETF has a website that will very clearly say if there's a currency risk or if it's currency hedged.
Yeah.
But because by the same token, if the US dollar does really well, you get a benefit, but if it's currency hedged, you miss out on that benefit. So there's risks and benefits, but...
I think to answer basically or more generally that question is usually the big banks they all have their own brokerage service, and they generally charge on the higher end of the fee spectrum per trade, especially if you're going international. I think CommBank charge almost $20 a trade for international, something like that.
Yeah, no, I think...
But that's not that much if you're just going one bang, is it?
Yeah, no. If you're
it depends how much you're investing.
$20, it's 1%.
1%.
Yeah.
Our general rule of thumb is you don't want to be paying anything over 1% in brokerage. Yeah. So it's not that much, you're right, in terms of a one-off payment. But if you're consistently investing, it all adds up. You might be charged.
Yeah, if you're consistently investing in small amounts.
Small amounts, yeah.
Because if you think about it, let's say it's a $20 investment and you're investing in $200 hits.
Or 500.
Yeah, but just for ease of my maths.
Oh, yeah.
Then you're 10% behind every time.
Yeah, your stock needs to go up 10% just to cover that. And then the reverse side is there's now great competition in the market from online-only brokers, IG being one of them, Bell Direct,
CMC.
Sharewealth, CMC. These are all online only, and they are very competitive with their rates. So you can sort of shop around. I think Choice or CanStar do very good comparison websites. and a lot of them align
Is
to.
that a plug for Choice or Cancer?
No, a lot of them align.
Well, we have interviewed Finder, so
Yes,
Finder
true.
do comparisons
Find
as
it
well.
up. Come on.
Finder as well, yeah. And a lot of them are different based on your style of investing. Is it going to be a lot per month, quarter, whatever it may be?
Would you recommend speaking to someone, as in getting a one-off advice? Because obviously I'm not getting advice for you guys, and nothing you're saying is, we all hear nothing is advice, general information only, and I'm not coming to you guys for advice, neither is this an advice session.
Give us a lawyer.
However, do you think there's utility, and I think this is a bit of it's not a rhetorical question, but it's a bit of a loaded question. Do you think there's utility in going to see someone for advice to say, this is what I want at the end of 2020, this is where I want my money to be, or this is how much I've got to spend. I want to get a bit of this, get into that market, this market. Do you think it's a good idea to get that one-off advice from a professional to say, yep, that's a smart idea, that's a bad idea for this reason, etc.?
I think your personality, yes, sometimes. Yeah, I think that's.
But not for everyone.
No, I don't think so.
Do you think there's not a risk in sort of just not knowing much about the market, saying, I didn't even know it was an ETF. I'm calling it an EFT. Like, just going, I'll go and get some European renewable energy market.
So I think
ETF.
Good question.
Yeah, I think there is always just the basics. It's good to get advice. And I think for me personally, one of the things that I always felt was like I didn't have enough money to get advice.
Yeah, that's...
Like I was wasting my time.
Yeah.
And I reckon probably everyone's felt that. And probably, we're all starting our career, we've got a few grand. It's like we'll lose all our money just paying a financial advisor.
It does cost a lot.
Yeah,
But not for a one-off.
The thing is, you can always ask how much they cost before you spend it. And there are pretty easy ways to access it. So the government has a Money Smart website where you can put your address in and it will give you all registered financial advisors. And then the Financial Planning Association of Australia also has a search function for all registered financial advisors as well. So probably use one of those functions because you're going to get someone who's got the right qualifications, all of that. And it makes sense just to, some of them might do a free introductory session.
That's exactly my point. I was just going to say, I have my gut feeling with one-off is that you could almost Google the same format that they'll give you, is my feeling, right? I feel like your first one-off session, they'll just be like, diversify, 25% here, 30% there. And maybe that's what you need.
But that isn't important in and of itself. Just being able to have a form, Kip's here, being able to ask us questions. A lot of people don't have an ability to ask us questions. They might, listen to the podcast, but at the end of the day, looking across the table from someone and being able to ask a question is probably a useful thing to be able to have.
But you also pay for what you get. You get what you pay for, right?
Oh, absolutely.
So if it's a one-off free consultation, maybe that's not
The podcast is free.
I remember I did a session with one financial advice firm specifically for millennials. I'm not going to
to come back to that. This is an advice.
I'm not going to name names. And they charged $650 a month for their services.
For millennials.
For millennials, yeah. And I'm like, give me a millennial.
Just also explain to me, I know it's a business thing and it's where they're pitching it, but why is financial advice for millennials different?
It's not. That's
just
the
maybe
thing.
the way-
Well, just time
way it's communicated,
horizon,
I guess.
yeah. And then they're like, we've got a case study of John, 28-year-old investment banker who... I'm like, stop right there, mate. We're not all investment bankers.
So I've got nothing against an obligation-free appointment. I actually work for a no-win, no-fee personal injury law firm. I deliver an excellent service, not only in the first appointment, but in every appointment that follows. And that's beside the point. Yeah. Anyway, we can come back to that. But I've got nothing against an obligation-free appointment or a first free appointment. But I guess what I was asking, and I think if I was to do that, I feel I'd be comfortable paying something in the vicinity of maybe as high as $400 or $500 to get a really comprehensive, mini plan, because that's an investment in itself.
Mm-hmm. It's
Who
also
knows if that person, that man or woman's doing a good job, and just going to have to trust them or not. but they're going to give me some direction, hopefully, some advice, some risks, some ins and outs. And on that basis, I can then move forward with a bit more confidence. Because at the moment, I might just speak to you guys and say, I was interested in AGL, so I asked Randers about that. And so now I might move into an ETF that's on renewables and energy. But who knows if that's... I don't know anything about it. It would be good to get a professional's advice on that.
Mm-hmm. And probably the important thing to understand is that a lot of financial planners and advisors can advise you on your individual circumstances. They can tell you, some basic things and tax things, but they're not going to be able to tell you to invest in AGL or not.
Yeah,
and they're
that's
not
the
going to be
thing.
able to predict the market
They're
any
not.
better than...
Yeah. They will give you general asset allocation advice, is my understanding.
Yeah.
They won't. They'll still leave it up to you to be. I could be totally wrong, but that's kind of the vibe I get from those sorts of sessions.
So I think it's probably important to understand what you want to get out of the session and maybe speak to them on the phone before you book it in, and understand if what you want to get out of it is what they can offer.
Yeah.
Because as you say, you're a lawyer, and if your clients just expect to walk in and 2 weeks later get handed a check, you probably need to set expectations early. And same with financial advice. It's heavily regulated. It's very specific, and oftentimes it doesn't match expectations.
Mm. Nice. Well,
Not saying that you couldn't get a check in 2 weeks though.
Hasn't happened, but strange things.
Well, we're approaching the 60-minute mark, Ren, so...
Yeah, we thought this would only be a 20-minute chat.
I feel like we could almost talk for another hour, so...
Well, let's...
we might just take it offline.
Let's take the rest offline.
We'll stop talking about finance. But maybe before we wrap up, is Kipper, you sort of have a pretty clear direction.
I am an equity mate.
You are,
Yes.
you are, yeah. Is there anything that sort of plays on your mind as you think about going down that path that you've sort of laid out in the last hour for us? Any burning questions that you think you have and other listeners might have as well?
No, I thought it was just spend an hour talking.
Yeah.
So I don't think...
So nothing left?
No, I think it's been great.
Great.
Yeah, no, it's been good.
We'll check back in. What do you reckon?
Yeah, maybe we can check back in whenever you guys run the show.
we run the show twice a week.
No, you guys run the show.
Okay, I see what you mean. Well, I guess it'll have to be when
you did lay the pressure on early. For those listening at home, playing at home, I said this is the first equity mate to get on. So if it's a flop, we won't be doing another one. So the pressure was high.
Look, I think you delivered though.
Well,
we'll let the listeners.
We'll let the ratings be the judge of that.
I think it was a successful start to what I hope to be more sessions like this with other mates of ours who are also in a very similar position to Kit.
Who else did you get on?
There's a lot of people. Yeah, a lot of people. Anyone we speak to is in this position of wanting to.
Maybe you should get a listener on.
No, I was just going to finish with that, so thank you for prompting.
You guys should keep me on. I'm here.
My call out is to any listeners that would like to sit down with us and have a beer. We have been having a few beers as we speak to Kip, so it's all fun and games. If you'd like to come and join us and have a chat about your experiences.
Although the snacks were taken away.
If
you're up for snacks and the bed, the snacks were removed early.
The listeners are thanking me because they didn't hear us munching away throughout the interview.
That's true.
So by all means, we would love to speak to our listeners about their investing journey, be it about to start or if you're 6 or 12 months in, whatever it may be. There's huge value in sharing these experiences. I don't think you can really put a price on this sort of stuff. So
yeah, I think because if you have questions, you're probably not the only one with questions.
Absolutely, yeah. And even though everyone probably has very similar questions, there's absolutely no harm in answering them all. So reach out to us on all of our channels. As always, we're on socials, Facebook, Instagram, bit of Twitter, not really, but and as Kip said, if you haven't already, sign up to our Thought Starters, which is a curated email every Monday morning with interesting articles that will pique your interest.
And if you want to reach out to Kip, unfortunately he's not on social media because he's too good for it. So
I just think it's a weird little universe. I was at work the other day and I saw, not just at work, but you see people on Facebook and there's literally just scrolling through other people's lives. It's weird.
It's addictive.
it is
People,
strange.
and
Like you don't only
maybe it's a good
only
investment,
old
though.
men sit on the street and watch people go about their lives, which is actually pretty good when you think about it.
That's
But-
old school social media.
exactly. But when I don't know, I'm not entirely comfortable with it. But maybe I'm.
No, I agree. It's weird when you're watching someone like on a tram or something, just double tapping,
looking,
scrolling,
yeah.
double
do you never
tapping,
think to invest in Facebook based on the fact that every single person you see uses it?
I think I'd have a
A moral dilemma.
yeah.
Interesting. Fair call.
Yeah.
Yeah.
We'll have to save that for our second interview.
Yeah,
Mini-series.
Kids'
Moral
morality.
and ethical objections to investing in.
And Bryce wanted to live forever and Kip didn't, so we can really unpack that one as well.
Yeah,
No,
true.
if you want to reach out to me, I live with Ren, so not that you'd want to reach out to me.
They might.
But watch this space for the people you meet. That's all I'll say.
People you meet.
When if and when that does eventuate, we will be sure to
When?
give you a free plug on the podcast.
get me on.
Yeah,
Get
maybe
me on
we'll even
again.
get you, maybe that will be when we bring you back.
Yeah, that's not a bad idea.
Bit of cross promotion.
Well, we're sort of working to two timelines. Then end of 2020, I think I'll have a product to,
There you go.
To sell. Maybe we'll have our coffee book by then as well. Coffee table book. Called Meet the Investor. The investors you meet.
Oh, no,
And you'll be the front cover.
and it will also have our favourite charts in it.
how it went horribly wrong.
By Kip, probably. Anyway, good chit chat. Ren, as always, good to be talking stocks with you and to have one of our best mates join us and share his story as a beginner investor. And full credit, Kip, to coming on the show. We sprung it on you absolutely very last minute, so I really appreciate you coming
Thanks for
on.
having me, boys. Keep up the good work.
Thanks, mate. You're not listening to any of it. So.
I love your work. And,
Anyway,
share it with your family and friends.
yes, pass it on. So if there's nothing else to add, Ren, we'll leave it there and we'll chat next week.
I think that's it. Until next week.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity